Alright, so hey guys, today we're going to take a look at Gilead Sciences. They trade on the NASDAQ. Industry would be healthcare, their sector is biotech, and their ticker is GILD. And let's go. So basically, their two main areas of focus are HIV and hepatitis. After they acquired two companies in 2006, that allowed them to kind of branch into the influenza market via like pulmonary diseases. So they have a $1.36 billion market cap, which puts them at actually the 46th largest, which was something I couldn't imagine. If you take a quick look, you can see, smaller than CVS, McDonald's, in their kind of industry, Medtronic, United Healthcare, Allergen, which really surprised me, but the one that surprised me the most, GlaxoSmithKline. So bigger than them, we have Johnson & Johnson, to be expected. Novartis, to be honest, I have no idea who they are. Pfizer, yeah. Honestly, I thought Pfizer would be probably second, or if not even first, and then Merck. So they're fifth in healthcare. They have $1.36 billion market cap, as mentioned, primarily operate in the US of A, and lastly, have an almost 2% dividend yield. So quick look at their structure, pretty boring. Just going to mention that CGI Pharm and Calistoga Pharma are the two who they bought out in 2006. So jumping right into it, most brokers, the mean for the broker target is $116. It's important to remember that's about a 1 to 2 year time window, whereas mine is a bit more long term. So my target is 140, which would give 60% upside. The thing is, that's a low ball. Like, that is a real low ball target that's using pretty high whack, pretty low growth. I mean, they are healthcare. They have nice margins, as seen up there. They have good catalysts to come. They have strong management who knows what they're doing. So, like, they've already hit 124. That's their high. So 140 from 124 is a joke. So, that 140 is honestly my 1 to 2 year time window. In 5 to 10 years, I can see these guys hitting $200 easy, which is supported by my football field graph. You can see the 140 right there, and then the quartile goes up, the third quartile, till it's looking to be at like 165. So, honestly, by the end of 2016, if this market environment kind of improves, I could see them hitting 150, 160, and 5 to 10 years down the line, easily that 200 to 250. So let's keep going. So just management, I'm just going to drop a quick tidbit so we can hurry up and move on to the Excel. Is that John Milligan, he actually just got promoted like 2 or 3 days ago, Thursday or Friday. So March 10th, from CEO to CEO, so that's pretty good for him. And that another board member, Robin Washington, she's their CFO VP. She's also a director at Honeywell for about 3 years now. So Catalyst, just, baby boomers basically retiring. So that's kind of like general for healthcare. And then specific to HIV Hep is actually that Gilead. Somebody actually tell me how I'm pronouncing that, because Gilead. I have no idea. So somebody tell me how to pronounce that, please. Yeah, they also continue to acquire new companies. So like, they're going to be here for a while. They can weather any storms. And back to the HIV drug, they're just basically waiting on FDA approval for new HIV drug that there'd be high demand for, because the thing is, lots of HIV patients become resistant to drugs once they start taking them, so they have to kind of like move on to something new after a given amount of time. And the thing is, even if the FDA rejects it, it's all good, because Gilead is so diversified that it doesn't really have a bearing on their longer term success. So now jumping into a bit more of the math. So looking at the DCF, that 510 is the outlier, and I'm going to address that later on when we look at the actual Excel. So that 142, 138, yeah, so there we go. So that's seeming pretty high whack, and like growth of 3.5, or if we look over here, like, 11% whack, 1.5% growth. So honestly, I think this kind of like barrier here, this frontier over here, is more accurate. It's, like 190, 192, 194. My calculated WAC was like originally 7, but then I redid it using more better like industry averages, and I gave 9. The growth rate is like somewhere at 3. So really, through my math, it should be 194, but using a sensitivity analysis where basically I pulled, like I'll go into it, but the median of all this data ends up being here. So that's why I'm saying 140. So basically in summary, strong buy, 140 to 150%, 140 to $150. So that gives 67%. If you take a look here, like I had been saying earlier, they'd already hit 124, so it's no big deal. And now we're going to move on to the Excel. So basically I put in the income statement, the balance sheet, the cash flow statement, and then these three here are kind of optional. So measure, which is where they break up the revenue by kind of like the specific product, and then segment, which was they kind of look at each segment and then list the revenue. Whereas by measure, this is all under the same heading, and then geography. So some like analysts like to use this, you know, for something like Apple. If, who knows, Europe is experiencing a recession, demand for Apple products might be lower in Europe while it continues to go down in the US. So you can kind of like project that out nicely. So global environment, you're going to want to pull GDP data, both historical, estimated, and then projected from the IMF, because we're going to need that later to give us our WACC. Our terminal growth rate. So once again, Gilead, yeah, I talked all about that. So yeah, I started this Friday, Saturday. So it's still pretty current data. I'm going to try to get it out by market open Monday. Short interest only 1%, so it's serious. Taking at the WACC, further capital structure, debt to equity. I take an average of the last 10 years. The thing is, it's kind of using a lot of debt in the last few years, so that turned that into like 68. And that's pretty high. That falls out of line with industry averages, so I applied a weighting of just 50 to bring it more in line with industry averages. To get their debt, I just pulled it from Morningstar, took the value times the yield to maturity, and that gave me the debt. You divide that by the actual value of the debt to give you your cost of debt. Effective tax rate, something funny. If you look at is it in their income statement? No, they're geographical. There we go. If you take a look, they actually have a decent, like, look at that. They have a subsidiary in Canada, as we mentioned earlier, but that only represents 8% of their total property, plant, and equipment. So then the US is 72, and then you have Ireland, which wasn't even mentioned, but we all know what Ireland is there for. And that's pretty funny. Here's how we make the link. Ireland represents 16.4 of their PP&L. Let's go over to the Y for a second. Their effective tax rate, 16.4. So that's pure coincidence, but I'm not gonna explicitly state it, so you can figure out what the connection I'm trying to make is. Ireland, using a nice big chunk of their property, plant, and equipment, and their effective tax rate is way lower than 40%. So think about that. So the cost of equity by CAPM. So basically I took the risk-free rate since the beginning of the year, sitting around 2%, and then the market return since 1950 on the S&P 500. That gives you cost of equity, and then you take your debt cost of debt of 3% times 84 because of the tax rate to give around 2.6. You weight them together, and that gives you your WACC. Okay, so basically here's where the brunt of the work segment assumptions. So I'm going to take revenue, I break it up by each segment, I project out each segment, and then retotal. So it's kind of like, it's like a dial that lets you fine tune each segment versus just kind of like one big dial for all revenue. There's more fine tuning involved, so that's why I like doing this. So in the final year, they have like 5.25% growth in their revenue. I'm gonna give that 10% weighting. I give macro growth a bigger weighting, so 90%, and that gives us terminal growth for almost 3%. So you're gonna do the same thing for expenses. You break down your operating expenses, and then you kind of total up your selling and general admin, your depreciation, amortization, and your research and development. And you pull your capex from the cash flow statement. Same thing for working capital. And then you come back to the income statement. You total it all together. And then what you do is in the DCF, I ruin the fun. ruined the best part. You just basically self-reference what you had in the segment, just kind of figure it all out. Then we get our EB at, so I guess earnings before interest after tax. Put back depreciation, take off CapEx, take off net working capital. If it's positive, add it back if it's negative. It gives her free cash flow. Then we have to discount the free cash flow using the WACC. So in 2020, that's like 4 or 5 years out from now, you're going to take 1 minus this around 0.91. You're going to say, basically the other way you can do it, or just 1. You're going to say 1 divided by 1.9 to the power of the years, because that's per year, the WACC's per year. So it gives a discount factor of 64%. So only 64% of this future value is like equivalent in present value. So these are the present values of these future cash flows. So then we take our terminal growth rate, we reference back. We look at our terminal beginning cash flow. So you basically take this times the terminal growth rate, because it's kind of like, this number here represents kind of like the year after, basically. We re-reference the WACC. We get our terminal value by taking the difference between the WACC and the growth rate. It's around 7%. Then we take our present value of this terminal value by doing the same thing and discounting this by the 5 years. Oh, no, not by, well, yeah, it's already discounted. So you take this almost 323 billion, and you take 2/3 of that to give around 200 bill, but then we have to re-add the present values of the cash flow. Otherwise, it's like we're discounting twice. So that gives 2 3/4, 275, I guess, $billion. We take off our net debt. So for that, you go into the balance sheet. Gilead has no preferred equity. So that ends up with 2 2/3, $100 billion. That's our equity value. They have 1.42 billion shares out. So you take this, you divide by this, $188. Current price is $90, so it's basically 100 right there. Now, that's a discrepancy of about $50. The reason for that is you run a sensitivity analysis. So look at the difference, just kind of like, say your growth rate is actually 4 instead of 3. Assuming the same WACC, you're going from 200 to 250. So that's a like discrepancy of 25% right there. So for that, you set up a table. I might make a video on it, on how to do all these kind of like things. It's called sensitivity analysis. So you make this table. I basically take out anything more than 300%. So right now they're going for $90. So 90 times 3 is 270. So if it's anything more than that, I don't include it. Then I take all the quartiles, the means, the medians, etc. Are we good for time? Yeah. So it's just heading back there. And that spits this out. And so Gilead Sciences target price, $138.23, which is a really strong buy. I might buy 1,000 or so shares, 1,000 shares, I wish, $1,000 worth of shares this Friday when I get paid. But yeah, so my window is 1 to 2 years, so get on that. I made a post asking for companies you guys want valued, so check my user account and you can find the link. And yeah. Hope you guys enjoyed. I'll definitely be doing more of these. It was pretty fun. The worst part is just doing all this formatting. Formatting is the worst part. Once you have it all formatted, you're just re-referencing, and it's a lot simpler. So I hope you guys enjoyed. And thanks for watching.